What's up, you guys? Nick here from Nick's Taxes, and we are officially in tax season, so I thought today would be an appropriate day to make a video talking about some tax saving tips that you might not be aware of that you can file for 2020. These will help save you some money, especially in the year in which we saw a lot of recovery benefits. There might be a chance that we see a lot of Canadians in a balance owing position this year rather than a refund because they've received so many of these social benefits, such as the Canada Emergency Response Benefit and the Canada Recovery Benefit. So I'm going to talk about a few tax credits, some tax saving tips that might lower the amount of tax you have to owe this year. Obviously, these won't be applicable to everyone, but you can pick and choose and look into more information on the ones that are applicable to you. So before I get into it, if you're new to the channel, please give this video a thumbs up and consider subscribing. It just helps my channel grow with the whole YouTube algorithm and such, so I would appreciate that. So these are going to be actual tax saving tips. Claiming the basic personal amount is not a tax saving tip. Although if you are new to Canada, or if you have left Canada, then your basic personal amount is going to be prorated based on the number of days that you have been a Canadian resident. But that's really the only thing you need to know about the basic personal amount. First thing that I want to talk about is the disability tax credit. The disability tax credit is obviously for those who are disabled, but that could be a mobility issue, that could be a vision issue, or a physical issue. But with the disability tax credit, it's a little bit different than most credits that you claim on the tax return. You actually have to get approved by both the doctor and then the CRA in order to claim this tax credit. So there needs to be some work done on the back end to actually get yourself ready and available to claim this credit. In 2020, the maximum disability amount that you could claim is $8,576. And if you're claiming it for a person under 18, the maximum amount in 2020 is $5,003. So because of the complexity of this tax credit and the fact that you need to get approval from a doctor and from the CRA before it gets claimed, I've teamed up with a company called Grants International, and we made a video a number of weeks back that I will link here for you guys to check out and learn more about who Grants International is. But I'm going to have a link down in my description, and that link there, I would suggest if you believe you qualify for the disability tax credit, or if you even know someone that might benefit from this, click the link down below. You'll fill out a quick few questions, and then it'll go over to my friends at Grants International, and they can help you get that disability tax credit. They only get paid when you get paid, so there's no obligation when you fill out that form. But again, the link's going to be down below, and they can help you get this credit. And once you actually get approval, you might be able to refile your old tax returns and get more of a refund back on prior years if you were eligible for that disability tax credit in those prior years. And then going forward, you will be able to continually claim it so long as that situation fits you. So that's the disability tax credit. Kind of leading off of that is your medical expenses and medical claims. So one of the interesting things about medical expenses in Canada is it's a little bit different than our actual tax year. As you know, our taxes go from January 1 to December 31st, and that's our tax year. So all of the income and credits and whatnot that we accumulate during that year is what ends up on our tax return for that specific year. Medical expenses, we have some flexibility. Medical expenses, you can choose your tax year, and so long as that tax year ends in the year in which you're filing your taxes for, you're able to claim those expenses on that tax return. So for example, we're doing 2020 taxes right now. I could have a medical expense year from June 2019 to June 2020, and within that time period, claim all of my medical expenses I accumulated on my 2020 tax return, even though some of them were from 2019. The only thing with that is once you establish your medical expense calendar, that is the calendar you have to stick with going forward. So if you're expecting maybe a big procedure or something where you're going to be claiming some heavy medical expenses, it may be beneficial to kind of adjust your medical calendar year over a certain period of time, so that way you get the deductions in a specific tax season rather than another. The other big thing about the medical expenses is that you can claim your spouse's medical expenses or your dependents on your own tax return. So you have the ability, if you have a spouse, instead of your spouse filing their medical expenses on one return and your medical expenses on the other, you can actually combine them and put them on one tax return. This might be beneficial because medical expenses need to exceed a certain amount. And that amount for 2020 has to be greater than $2,397 or 3% of your net income. So you need to have your medical expenses exceed those amounts, otherwise they'll be washed out. So those are kind of like the basic thresholds. So if your medical expenses are, say 2,300, they'll get washed out by that 2,397 threshold. They have to be above that before you can actually claim any medical expenses. Now, the CRA has a full list of things that are eligible for these claims and things that are not. So if you're interested in learning more, definitely check out the website, and I'll have that linked in the description. But things like obviously your medicine, your anything medical related or dental related, so long as you're paying out of pocket for it, you're able to claim those as expenses in the tax year that you so choose. Not only yours, but your spouse's and your dependents. So definitely take a look at that. With a claim like this, Canada, when you file your taxes, it's a self-reporting service. So if you're filing with NetFile, Canada might flag your return for a review notice, and they might ask you to send in the appropriate documents to support the claims that you made for this medical expense. So therefore, I suggest if you're going to make these medical claims on your tax return, to keep copies of your medical receipts as backup for the amounts that you've claimed on the tax return, just in case the CRA asks for that proof. Tax credit number 3 that I want to talk about is available to the majority of Canadians filing taxes, and that's an RRSP deduction. You get RRSP contribution room by having Canadian earned income. So if it's your first year filing a Canadian tax return, you won't be able to contribute any amounts into an RSP at this point. But once you file a first tax return and have some contribution room generated, you'll start to contribute into an RSP. So a registered retirement savings plan is just an account. It's a tax preferred account in which they have certain rules. And one of those rules is you are able to deduct the amount that you contributed into your RSP off of your tax return. So if your taxable income or your income that you earned is $100,000 and you contributed $10,000 into an RSP, well, now your taxable income is going to be $90,000. The amount that you contribute into the RSP knocks off that amount on your actual taxable income. So you can save some money that way while earning some potential investment income, interest-free or tax-free, so long as it's in the account. The idea is that you're saving long-term for retirement, and the tax treatment is deferred until you actually take the amount out. The idea also is that you're deferring your taxes until you're in a lower tax bracket. But if you're younger and you're starting out, one thing that you might want to consider is deferring your RSP contribution claims into a previous year. So for example, if I contributed in 2020, but I know in 2021 that I'm receiving a promotion and a hefty raise, or if I'm receiving a large bonus in 2021 that I know is going to substantially increase my income compared to my prior year, I may be better off carrying forward my RSP contribution to that year in which I'm earning more income and therefore in a higher tax bracket. When I'm in a higher tax bracket, I'll recognize more tax savings from my RSP contributions. But if your years are pretty similar and pretty typical, often it's not really worth it to carry forward your RSP contributions for saving a couple bucks. You're better off putting that towards your current year. But obviously you can take a look for yourself and make that determination and do what you see fit. I've made videos on how to use tax calculators such as the cloud tax calculator, and you can kind of put your values in there and you can see the potential savings that you might have from carrying forward RSP contributions into a future year, or you might just see the savings that you'll recognize this year. The other great thing about RSPs is for tax year 2020, I had the first 60 days of 2021 to contribute to my RRSP and apply that towards my 2020 taxes. So you get a little bit of extra room and extra time to make those deductions from your tax return. And last but not least, if you had to work from home due to COVID-19, there are some home office expenses that you're able to deduct off your tax return. There is a flat rate method and a more detailed method. The detailed method requires a separate form from your employer. If you don't have that form, I believe it's called a T2200 or a T2200S. If you don't have those forms, you can't claim the detailed method, but you're still able to claim the simplified flat rate method. And that's $2 a day for every day you had to work from home due to COVID, up to 200 days. So the maximum you can claim is $400 using the flat rate method, and there's nothing else you have to do except claim it on your taxes. So that's something you want to make sure you're looking out for, because on the tax softwares, it won't prompt you for this. You'll have to take a look and find this deduction in the software that you're using and make sure that you make that claim. So those are 4 tax credits that you can take advantage of for tax year 2020 and potentially beyond. If you got value out of this video, give it a thumbs up and let me know in the comments below what tax credits are your favorite or what ones you're claiming this year. Thanks so much for watching. I'm Nick. Happy taxing.